please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Achieving your goals via proper financial planning is more like a marathon and less like a sprint. That's because in any financial planning journey, there will be ups and downs. But how do you manage that volatility? Well, that's a big question, but we're here to help you answer that. Hello and welcome to NSE FinWiz Season 5, powered by CNBC TV18. I'm your host Gautam Srinivasan, and today we are in Chennai at the campuses of one of the world's largest technology players, Mphasis.
Mphasis enables enterprises to become fast, innovative and personalized in their response to digital disruption. Over the years, the company has provided IT services to organizations the world over. NSE FinWiz, with its initiative Dream On, is at the Chennai campus of Mphasis to engage with IT professionals on the merits of planning their personal finances.
According to me, financial literacy is all about how you manage your expenses and debts as a youngster, and also how exactly you manage and control all the expenditures, and apart from that, how much you invest and where exactly you should invest.
Wealth management, it's very important because as this is like the trend changes and everything changes, nothing is constant, and also we should have a proper management of everything. It's not only about our retirement plans, the present also, so whatever we are earning, so how to spend them and how to invest them in the proper place so that it will be further useful for the further things.
From today's event, I'm expecting, like, as a fresher, I would like to know like how I can invest my money and how I can make use of the money which I am getting, and which will be useful for myself.
I would like to ask them what are the better option for investments for employees like us who are just starting their career, so we will be having a good future.
Welcome to NSE FinWiz Season 5, powered by CNBC TV18. Today we have a very interesting topic of discussion, and it is market volatility, and we have two of India's top financial planning minds with us to explain the ins and outs of it and see what we can make of it. Gajendra Kothari and Harsh Rungta, both with us to explain the concept, and of course the working professionals here at Mphasis. They have a lot of questions on the topic, so we better be set on that. But before we take a deep dive and take their questions, and let's start with the basics. Now, Gajendra, 2017 was a great year for the markets. We saw a lot of buy on dips action. There was a lot of optimism about the market. But 2018 seems like a different year. We've seen significant corrections so far, and market volatility by many experts, according to many experts, is here to stay. So what makes a market volatile? If you could give us a basic primer on that.
The market is a mixture of buyers and sellers. There are people who are buying, there are people who are selling. If there are more buyers than sellers, then markets would go up. If there are more sellers than buyers, markets would go down. It's, at the end of the day, demand and supply game.
But is the sentiment a big factor? Because a lot of people would be wondering, I'm, say, holding a portfolio which is, all domestic stocks, and, whenever people hear about Fed rates and suddenly the market goes up and down. So some of them might be wondering, why exactly is it impacting, say, my particular portfolio, which at the face of it shouldn't be impacted by it? What do you have to say for that?
In the short term, stock market reacts to news, which keeps coming out, whether it's macro news or company specific news or global news. It can be any news, right? And because news flow come in, people would like to take a guess what this news will have impact on the stock price in the coming months or years. And as a result, each one will do their assessment and take a call and do some action in the portfolio, which will result into a volatile market.
Harsh, for the beginners out there, let's address this question of how do they gauge, how much volatility can they take?
By its very nature, when you invest in equity, when you invest in stocks, or when you invest in mutual funds that invest in stocks, okay, over the short term, you are going to see the prices go up and down. Those are like, when they go down, okay, they are like the traffic jams that you encounter. As long as you focus what you are investing for, if you are investing for your child's education maybe 10 years from now, 15 years from now, right, and the traffic jam has occurred just now, just as you start out, it should not matter, right. So I think the key issue is please focus on the goal.
All right, but that is when you have the goal. Now, for those who are starting out, and especially in an environment where there is pessimism, how do they start out and avoid being, say, returns chasers and focus on being goals chasers? Because when the markets are good, it's easier to, calm yourself down and say, yes, I will achieve my target, I think I can do it. But it's when you start seeing significant corrections, that's where the fear psychosis immediately comes back.
The way you should go is actually invest through funds where an advisor is there who knows what's your risk profile, what risk you can take, what are your goals, or you may not have goals, but at least I know what kind of background you have. Then I will suggest you funds which are matching your risk profile. When you invest in mutual fund doesn't mean only equities or only risk, bearing assets. Right from bonds, right from FDs, liquid funds, you have something called liquid funds where your money is absolutely safe, no volatility, but it gives you 6% return. Up to 20% product where it is complete volatile. So we have a range of products. So we'll start with something like bond funds where you're earning 7-8% FD kind of return. And over a period of time, as you become acclimatized to this environment and as you understand risk, as you start understanding these nuances, we slowly up, the risk level. And then you are fine taking it because now you understand.
All right, but the point here would be, say, if you look at bond funds as well and if you look at equity funds as well. Equity funds, people understand that there is volatility as in terms of the returns on an immediate basis, which is why people look at it in a long term. Bond funds are supposed to be a sort of, don't worry, not enough, the chart won't swing wildly either way. Broadly as an asset allocation strategy, what's a good starting point in such an environment when people are looking to go defensive, not earn, underperforming returns, but at least something to beat inflation for the time being?
You can't beat inflation without taking risk. What you would get from so-called riskless instruments are the fixed deposit kind of. So you mentioned about bond funds returns not being very good, but you put it in liquid. Okay. Again, in liquid funds, your return would be good, equal to the fixed deposit for an equivalent tenure, but they are taxable. So because of the tax, okay, the return net will unlikely to be beating inflation. In the long run, over 10 years or 15 years, the risk of your money not keeping up with inflation is a much larger risk, right? You start out with 1 rupee. After 15 years, if you have kept it in a fixed deposit kind of an instrument, because of tax and low returns, what will be left will not be able to buy you the same amount that you would have bought when you started your investment. And that is a certain risk versus an supposed uncertain risk about the prices going up or down.
All right, always look at the long horizon, don't worry about whatever is happening in the immediate term. So let's dive right back in. Now, you were discussing about SIPs earlier, Harsh. And now in a volatile environment, are top-up SIPs the way to go? Because at the end of the day, as you mentioned, rupee cost averaging works to everyone's benefit. So is that the way to go for a lot of folks who are wondering, what happens when volatility is not just a short-term phenomenon, but is an actually a multi-year phenomenon?
So one is even the regular SIP or the regular recurring deposit, where you just put in the same amount of money month after month. Then, so that what happens is when prices are low, when you're putting in the same amount, you will get more units, right? And when the prices are high, when you put in the same amount, you will get less units. That is what is called rupee cost averaging. Now you imagine that you have you increase your SIPs, say year after year, or you could increase your SIPs depending if the markets are in a certain zone. So assume that the markets are low, and if you increase your SIPs, you will get even more of the units. And now there are, what shall you say, formula driven SIPs available. The idea there is not to let emotions decide, but to let the system decide. So whichever you follow, the regular SIPs, standard amounts every month, or something that increases, okay, as long as you don't let fear rule your decisions, I think over time you will make.
For the minority of investors who do invest in funds, what are some of the do's and don'ts of rebalancing a portfolio in times of market volatility?
In mutual funds, there are something called asset allocation funds, where again you don't have to track the markets. So these funds would put in a mixture of equity or debt according to the market levels. So if the equity markets are going up, your investments in equities would keep coming down, okay? And every time markets go up by 5%, they book profits, put into a debt fund. So as equity goes up, your investments in equities come down. As equity markets go down, your investment in equities goes up, because then you're buying equities at a lower price. So they are doing it automatically for you. So if you're an investor who is not tracking the markets, who wouldn't like to track the markets, you are happy doing your work, what you're good at, I think you can invest in these funds, asset allocation funds.
All right, let's get in the audience to list out some of the goals that they have mentioned in the cue cards, and I'd like to invite S. Gautam to get up. We'll pass on the mic to you.
I have planned for accumulating 20 lakhs for the next 3 to 4 years, because like it's a well-known fact that in 3 to 4 years I can't earn 5 crores, 10 crores or 15 crores something. But to start up a small scale industry, that's more than 20 lakhs is more than enough for me, I guess.
Okay, so 10,000 per month he can save, and 20 lakhs is his is the corpus that he is looking at in terms of starting a new business that he wants to do, and his time horizon is 3 to 4 years.
3 factors here. Either you have to reduce the corpus, the target in mind, or you have to increase your time horizon, or you have to increase your monthly amount which you are willing to invest. You have to change either all of 3 or one of these 3 in a big way. And particularly since your time horizon only 3-4 years, you can't take much risk also. You can't be in pure equities. You know, your money has to be predominantly into debt with maybe 10, 20, 30% equity exposure, not more than that.
All right, the next person I'll call out from the audience to list out their goals is Arshia Gulrez, if you could get up.
My dream is to go on a world tour. I have a minimum target of 10 lakhs.
So your time horizon is around 15 years, I guess. All right, so can save around 5,000 to 6,000 rupees a month. Is looking at a corpus of 10 lakhs to fund a world tour. So what's your advice to Arshia?
You got 15 years ahead of you. Keep increasing this amount. Put up a 10% increase every year. So 5,000 rupees per month in the first year, 5,500 in the second, maybe 6,000 in the third. Work that number out as long as you, and your earnings would be increasing, right? As long as you put increased earnings, and because it's a 15-year time frame, okay, your ability to take risks with that investment is high. So you could look at a pure equity mutual fund as well.
I hope we've answered your question. Thank you so much for asking. All right, the final audience member for this segment, who I'll call, is Srivatsan R, the delivery module lead, if you could.
I just started last year a mutual fund. I have invested in mid-cap. I'm having a doubt like whether I can go for a sector-based funds like FMCG or PSU or something like that, whether it will be good.
Let's focus on the goal first. You have said you want to settle all your loans and you want to do retirement planning, right? So totally, what is the kind of corpus amount you're looking at for all the things that you mentioned?
20 lakhs.
20 lakhs, okay. And how much can you save per month?
10,000 per month.
10,000 per month, okay. And so retirement planning would be around 20 years. Settling loans, as he says, is a 5-year horizon. So there's a lot of factors at play here, which I think we need to take, you know, piece by piece.
First, clear off all the loans, what you said, 5 years. You know, then the benefit of that is that what EMIs you are paying right now, that EMI, that money will be used, you can use as an SIP to start funding for your retirement goal. Having said that, retirement is not a very simple goal. It's one of the most complex goal, you know, because retirement has a lot of variables built into it. Your lifestyle, you know, what are your present expenses today? What kind of retirement you would like, you know, whether you would like to live in Chennai itself or you would like to settle abroad, or, you know, there are many factors, and it's a dynamic thing, you know, it keeps changing, okay? What will be the inflation then? What will be the cost of living then? What will be the returns of investments then? So, but there are many calculators available online. So I would suggest you to use that to arrive at a correct or a approximate retirement figure, and based on that you will know what is the monthly investment amount which you need to start. Now that SIP, that monthly amount can be 30,000. Today you may have just 10,000 rupees. You should not be worried with. Most people leave this exercise here This is no, 30,000 is what I need to save. I have only 5,000. I don't think it is possible. Let me not save itself. The biggest mistake which we see, you have to start somewhere. Start slow, start early. Every year you can increase your SIPs by 5%, 10% as your salary grows. Maintain the discipline and you'll be able to achieve.
Well, the topic of discussion is market volatility, and the floor is open to all the employees here at Mphasis to ask any questions they have on that topic to our panel of financial planning experts. So let's see a show of hands. Yes, we'll start with the gentleman there.
My question is how to invest without getting affected by volatility in the market.
Just to put in a very easy way, our heartbeats, go up and down. If the line were to be flat, we would die, right? So don't be afraid of volatility. Even in life, if it has both ups and downs, I think you enjoy better. If it was just same routine stuff, monotonous, you wouldn't be having a thrilled life. So don't be afraid of it. As I said in the beginning, make volatility your friend. The more you want to, as Harsh mentioned, you can easily invest in an FD where there is no volatility. But what bigger risk you are taking is not the risk of not meeting your goals 10 years down the line. You may want to have a great retirement. Your FD gives you 6% return. Your inflation is 8%. Then you're not able to retire at all. You'll have to continuously work for life, throughout the life. So start to understand volatility, embrace it, and I'm sure it will be a good run.
All right, the Swati Chaitanya, if you could get up.
My question is like, when will we know that actually we are ready to invest in stock market?
Just like in anything, you need to have certain basic minimum knowledge to do well. Having said that, stock market is not a rocket science, okay? It's, at the end of the day, we are buying stocks. Stocks are nothing but companies, okay? Why would the price of a company go up or go down, and particularly go up in the longer term? The common sense is the company making profits, right? If the company is making profits, everybody would like to own that piece of company. If you want to create wealth, wealth can never be created by putting money in savings bank account and fixed deposits, because there you're earning a certain rate of return. You may not be able to beat inflation. There are hardly few investment options available all over the world. Equities is one of them, real estate can be another, and gold has been said that it can just match inflation, it cannot beat inflation over the longer term. So these are certain points that why you should, one, invest in equities. Wealth creation is the predominant role. I always keep asking question, list down who are the 50 richest men and women in the world. Or so in India, you won't find doctors, you won't find cricketers, you won't find sports people, musicians, actors. All the 50 men and women are business owners.
All right, on that note, we will conclude this show of NSE FinWiz Season 5, powered by CNBC TV18. I'd like to thank our panel of experts here for sharing with us their insights on the topic of market volatility, and of course the working professionals here at Mphasis for a very engaging discussion that they've had on the topic, and of course for the viewers who have tuned in to understand more about the concepts of financial planning. Thank you so much, and keep watching CNBC TV18.
Since I'm in the beginning stage of my earning, I haven't started my investment. But post the session, I have got an idea to, I'll start investing in equity fund.
I don't know about the stocks and markets and the values and up and going down. So I have got a somewhat knowledge about these equity funds and mutual funds and those kinds.